Most people think rental property investing is simple. Buy a house, collect rent, retire early. But the real question is, are you actually making money or just pretending to? Cash flow is the heartbeat of any rental investment. And if you're not measuring it correctly, you might be bleeding out slowly without even knowing it. We're talking about the difference between an asset that quietly builds your wealth every single month and a money pit dressed up in fresh paint and a for rent sign. The stakes here are real investors who skip proper cash flow analysis, lose thousands annually, and some never recover from that first bad deal. So let's break down what cash flow actually means. It's the income left over after every single expense is paid: mortgage, taxes, insurance, maintenance, and property management. Think of your rental property like a small business, and cash flow is whether that business is profitable or just impressively busy. The catalyst behind most bad rental investments is simple people fall in love with appreciation and ignore operations. They see a hot market, imagine the property doubling in value, and completely forget that the water heater will break in February and the tenant will be 3 weeks late on rent. Here's where the optimism hits a wall. You bought in a booming market, rents were rising, vacancy was near zero, and every podcast was telling you that real estate was printing money. Then, insurance premiums spiked, interest rates climbed, and suddenly, your cash flowing property is costing you $300 a month out of pocket. Behavioral economists call this optimism bias, and real estate investors are absolutely not immune. We overestimate income and underestimate expenses every single time. Even seasoned investors have gotten caught flat-footed because they underestimated vacancy rates or forgot to account for capital expenditures like roofing, HVAC, or foundation work. History shows us that real estate moves in cycles, and the investors who survive them are the ones who stress-tested their numbers before buying, not after. Look at the 2008 crash. Properties that had thin or negative cash flow were the first to become albatrosses, while well-underwritten rentals with strong fundamentals weathered the storm and came out the other side, still generating income. Now let's talk about a common misconception that trips up a surprising number of new investors, that a property paying for itself means it's cash flowing. If your rent covers your mortgage, but not your insurance, taxes, repairs, and vacancy, you are subsidizing that property with your day job, full stop. The real framework looks like this. Take your gross rent, subtract vacancy at about 5 to 10%, subtract operating expenses at around 30 to 45% of rent, and then subtract your mortgage payment. What's left is your actual cash flow. If that number isn't at least $100 per unit per month at minimum, many experienced investors would walk away without a second thought. Platforms like BiggerPockets have long preached the 1% rule, where monthly rent should equal at least 1% of the purchase price. And while it's imperfect, it's a quick sanity check that keeps you from overpaying in markets where the math simply doesn't work. The community wisdom is consistent. Buy on current numbers, not future hopes, and let appreciation be the bonus, not the plan. Here's the rational, demystifying truth. Negative cash flow isn't automatically a death sentence. If you have deep reserves, a clear exit strategy, and the property is in a high appreciation market where equity gains offset the monthly drag. But that strategy requires serious capital, discipline, and honesty with yourself about risk tolerance, which most new investors dramatically overestimate. Practically speaking, always run your numbers with a property management fee built in, even if you plan to self-manage, because the moment your life gets complicated, you'll need that buffer. Keep at least 3 to 6 months of expenses in reserves per property. Size your positions conservatively, and never let excitement override your spreadsheet. The philosophical truth about cash flow investing is this: the investor who wins isn't the one who found the flashiest deal, but the one who consistently underwrote conservatively, held through volatility, and let compounding do its quiet, boring, beautiful work. Discipline in your analysis, patience in your timeline, and honesty about your numbers will outlast any market cycle, any interest rate environment, and any hot take from a real estate influencer. And honestly, whether the market runs hot or cools off, a properly evaluated cash flowing property is one of the few investments that can pay you in good times and bad. So getting your analysis right isn't just smart, it's the whole game. Comfort comes not from predicting the market, but from knowing your numbers so well that the market's mood doesn't determine your outcome. If you're ready to stop guessing and start building real cash flow, check out our links in the description below. Whether you need help evaluating rental properties, finding reliable contractors, or connecting with the right lenders, we've got you covered.